Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Guys, our guest for this week's show is a real estate and financial expert, Chris Nagel. Now, Chris is the co-founder and CEO of the Money School, which is an educational firm that teaches individuals how to take control of their financial future by becoming their own bank and ultimately leveraging the infinite banking concept. Now, Chris's expertise is it's quite significant. He's built and owned 19 companies, with his businesses being featured on Forbes, ABC, House Hunters. He also had his very own HGTV pilot back in 2018. So, guys, I'm excited to have Chris here, and so I'd like to welcome Chris Nagel to the show. Chris, my
Hey
friend, how you
man,
doing today?
I'm doing well. Thanks for having me on. It's an honor
Yeah,
and a
yeah.
privilege.
Hey, excited to be here, buddy. Excited to talk about, we're going to talk about money. It's obviously an important topic and one that ultimately is always top of mind, whether it's good, bad, or indifferent. It's always top of mind for everybody, I believe. And so, but before we dive into what it is you do, Chris, and the different concepts that you teach and educate on, why don't you give us a little bit of background of yourself, a little bit more about who you are, kind of where you came from, and ultimately how you arrived at, where you're at today, educating on this infinite banking concept topic.
Well, I certainly didn't grow up in a family with money. I very much grew up in a lower middle class family. My mom always taught me to dream, which I think probably the best part of my upbringing is just those huge dreams. And, the dreams that most people in your life tell you you can't do, you shouldn't do. And,
Mm.
they try to get you to redirect to what they were doing. And that was very much my story. Early on in my career, my life, I wanted to be a pro snowboarder. And I remember telling everybody in my family with just the most excitement as a kid. And everyone in my family kind of, they laugh, they say, "Oh, that's awesome, but I don't think you can do that here in Buffalo. We don't have mountains, we have hills." But I remember, I was just determined, and I did everything I had to do it, including practicing at a local country club, which was in a ravine. I'd build jumps out of sand traps, and that's how I mastered a lot of the tricks. And I would be doing that when everybody, all my friends would be out just doing whatever kids do. I'd be just hiking a hill, drilling these tricks. And then when I started really competing a lot, most of the competitions were out on the East Coast. So that's about a 7 hour trek from where I'm at. So every Friday, me and my friend Ben would load up in the car. We would drive all night Friday to arrive early Saturday, maybe catch an hour, 2 hours of sleep, hike the hill all day long because we couldn't afford passes back then. So we would just hike the pipe in the park and then, crash in someone's couch, do it again the next day, hop in the car and drive back from Vermont, New Hampshire, and Maine back home. And that's just what it took. So that was my early years. And I did become a pro snowboarder in doing that. But before that, I also became an entrepreneur because I realized at 16 that I just didn't want to work for anybody. I had some really bad jobs where the people I worked for just degraded me terribly. So I one day came home, said, "Mom, I quit my job, but I had a plan." And I said, "I'm going to start a clothing line in the basement." And that's
Mm.
where would have been 1992. I'm dating myself a little bit. 92, I started Fat Clothing Company. It was a clothing line that I printed the shirts with my art teacher after school, and I would sell them out of my backpack. And then that expanded to wholesale, that expanded to retailing, and then that also gave me the idea to open my first store. So that first store opened in November of 1994, 2 years after I started the clothing line. But a unique thing happened in between, and I mentioned the dynamic of my mom and how she always believed in my dreams. Well, to open Fat Man Board Shops, my business plan that I wrote with my teacher in the first year in college, basically I needed 70 grand. That was my startup cost for
Hmm.
this retail shop. And I didn't have 70 grand. No one in my family did. They actually all told me no. My dad even told me to go get a job at the factory, because this idea of being an entrepreneur was silly. So I remember my mom in the final hour of me just giving up on this, she put the house that we lived in, the only thing she owned, which was a 700 square foot, 2 bedroom, 1 bath home. She put it up for collateral so that I could get an SBA backed loan. And right then and there, that would have been November of 1994. I literally became, I was already an entrepreneur, but I became a very solidified entrepreneur that literally realized, holy crap, if I fail,
Yeah.
I lose our house, my mom's house. So all was well, though. I was living a fairy tale. I was pro snowboarder, running skateboard, snowboard shops, expanding all the way up to early 2000s when the dot-com crash hit. And that literally was the first recession that I felt and lived through as a business owner. And that forced me to get another job. So that other job, as weird as this is going to sound for a punk snowboard kid, landed me in Wall Street. So I ended up working in Wall Street right over at 51 Madison. And I spent lots of time in the Big Apple there working for this firm. And we had an office here in Buffalo that I became the number 3 financial advisor at that firm. So it was a very unique dynamic. I was still running the shops, still a pro snowboarder, but I was almost like Superman. I'd put a black, blue, or gray suit on, and then I'd work my financial advisory client book, and then I'd come to my shop at night and work the night shift till 9, 10 o'clock. And I did this for years and years and years, and it was really tough. And in this whole transition of this weird thing with the Wall Street job, I ended up meeting some really high net worth clients, and they never put any of their money with me. And I could never figure out, like, what is it with these wealthy individuals? Like, they never give me any money. I mean, they would put a little in a Roth, maybe a little in a SEP, or maybe we'd start a 401k for their company, but they never gave me their money. And I ended up sitting one of my clients down, and I said, why? Like, you got all this money, but you never like have me manage any. Is it because you don't trust me? Is it? And he's like, no. He's like, I'm a real estate investor. Like, I put my money in real estate, and my returns are so much better. No disrespect, but my returns are much better. I can control them, and this is what it is. And instantly, like, in my mind, I'm like, wait, why wasn't I taught this when I became an advisor? Why didn't they say real estate outside of REITs was a strong thing? So I had to try my own money in real estate, and that was my first flip, which was '06. Next one, '07. 2008, I bought a dilapidated building that I was going to convert. Big project. I was going to develop into a strip mall where my main store, Fat Man, was going to be the anchor. And then I was going to have a couple other tenants that I was going to rent out that would pay my mortgage. And you heard when I said that, like, I just got a thing with timing. That was 2008 that I borrowed money from a bad group of hard money lenders. I started this massive project right as the Great Recession kicked in. And that's like, that was pretty much the beginning of what I would have said would have been an end, but it wasn't. So I was one payment away from being bankrupt. I had a girlfriend who just moved into my house, and I remember sitting her down late one night saying, hey, I need your help paying the mortgage. I need your help paying the utilities. I got a couple friends that are going to move into my house. Like, oh, I can't believe she stuck around. I mean, she probably should have walked out the door, but that's how I made it through 2008. And after '08, I was really studying Warren Buffett, and I was reading every single book the man put out. And I literally had recited buy low, sell high, and don't lose money. Well, in '09, real estate plummeted, and I started just taking every nickel I had and buying real estate. And that's what I did from '09 to '14, built up 36 doors. So as a rookie real estate guy, I thought I was doing pretty well. I was working my tail off because didn't have management, didn't know what I was doing, but I was just finding my way. And then this is where the story really pivots,
And
and
this is
where
in
I
Buffalo,
really
correct? This is in
this is
Buffalo,
all
Chris.
in
All in
Buffalo.
Buffalo.
Yes,
Okay, got it.
all
Got
in
it.
Buffalo at this
Yeah.
time. Yeah. And gosh, I try not to think about those properties today as to what they'd be worth, because I had some gems in some up and coming areas. But unfortunately, I didn't make it that far, because this is where my hate for banks started. I was working with this bank, and this one banker had a great relationship with them. They saved me from going bankrupt with that strip mall by refinancing the building. But now I brought my 37th door to this guy. His name was Greg, great guy. And he took it to the bank, and they said no. And I didn't know why. And he starts explaining to me the debt to income ratios. And I started just showing him on my financials. I'm like, yeah, but I keep making more, these rentals and all this. And he says, it doesn't matter. He said, we have parameters, and every bank's going to be the same. So whether you go across the street, down the street, doesn't matter. Here's where you're at, which means no one's going to give you a mortgage. And I said, okay, well, I can't do this property, but here's where this he did something, and I don't know if he did it or if it was a component of the bank was being bought out. I did not know this,
Mhm.
but I had a line of credit that was vital for me to renovate all these properties, and it was backed by all the properties. It was like one of those bundled, I don't even think they have them anymore, but it was a bundled HELOC, if you will, on these commercial properties I had. Well, when they did my debt to income ratio, they froze that line of credit, and it was game freaking over. Kevin, I had to sell every one of those properties. And as I did that, like, I was so sour on real estate. I was sour on everything. I tumbled to new lows. And during that period of time, I was still dabbling in some flips because I could get in and out. But I met this guy who lent me money, Mike, and this was private lending. And this is where it brings me to the infinite banking concept. 'Cause even as an advisor, I want everybody to know I was an advisor up to this point that I'm going to get to for 14 years. And I spent 16 years in the Wall Street game. 14 years. I thought I knew everything there was. I mean, I played with some big boys. I was working with huge hedge funds. I mean, the group I was part of was really, really cutting edge, and we did some huge stuff. And, I'd never heard of this thing. So I was on a snowboarding trip in Salt Lake City, and I sat down with this Mike guy who was lending me money, pitched him a deal. But in doing this, I don't know, in conversation, I guess, I said, so Mike, how do you lend this money? And without a flinch, he says, I lend from my private bank. And I'm like, holy crap. Mike's got way more money than I thought. I had no idea this dude had a bank. So I literally said, hey, after lunch, Mike, can we check your bank out? I'd love to see it. And he says, oh, I don't have a bank. I just mimic what a bank does. I changed where my money goes. I don't put money like my savings. I don't put it in banks. I put it in my own banking system. I get a guaranteed interest rate. I get dividends and interest that grow tax free. And he's rattling this stuff off. Now, let me pause because I'm going fast. In my mind, as an advisor, everything's compartmentalized as there's a product for that. That's just how we were taught. So as he's saying all these things, my mind is saying, okay, guaranteed interest. That cuts all the rest out, and that's these things. Then he mentions guaranteed interest. I'm like, these and dividends, these. And then he mentions tax-free growth. And I'm like, what could this be outside of a Roth? But he couldn't do all this other stuff. And then he keeps going. It's protect against judgments and liens. And then he says, and here's, because I asked him, I said, how does it work? He says, when you come to me with a proposal, if I like it, I take a loan from my private bank and I give you the money. And then you pay me interest on my money. And then I take that interest and I put it back in my bank, the place where it came from. But here's the kicker. He says, my money never left my bank. It was still in there. So if you ask me for 100 and I give you 100, I still have 100 earning guaranteed interest, dividends, and it's growing tax-free. And this was the part where I'm like, either Mike is smoking something really good, but he was Mormon, so he didn't. I knew that. And then I'm just like, or I thought I knew everything, and now I'm realizing I don't know anything. And that's where I learned this process. I didn't learn it from Mike. I learned it from the guy that Mike was taught by, this guy, Brent. And my entire world, my perception, and how I treated and used money changed that day forever. And now the student, which I was a student back then, became the teacher, and I've grown to be, one of the number one in the space today. So that's my story. And I left a lot out, but you covered the HGTV got, so.
No, that's great. That's great. A lot to unpack there, and I want to make sure that we do focus on the infinite banking concepts. I'm sure that story that was a great segue into piquing the interest of those that are tuning in here today. And so definitely don't want to shortchange our time here to where we get off and folks don't have a basic understanding of what this is. And so, but I do want to unpack a few points of your earlier story. One that really stuck out to me is your mom putting up the home as, I don't think a lot of folks actually know how the SBA program works, and that typically you're required, it's a full recourse loan, and they'll lend you quite a bit. I think nowadays up to like 90% of the business valuation. But a lot of times they do make you put your home up, your personal residence up for collateral. And so I can't imagine the amount of pressure that you, or the weight you felt on your shoulders, given the commitment that your mother made to you. And that, if you fail, the roof over your head, the only thing that probably was of a significant value, in your mother's life of a material item, could be gone, could be stripped out from underneath her. So, but then again, as entrepreneurs, I think that's what that really separates the wheat from the chaff is being pushed, getting your back pushed into the corner and ultimately swinging and fighting your way out and ultimately finding your way to the top. So I wanted to just point that out more than anything else. We don't have to go any deeper than that, but that just speaks a lot, I think, to character, and ultimately that you found your way in this world into the entrepreneurial world, the right place. I mean, that's where you need to be, and that's where you were meant to be, and I think that's just a testament to it. So,
thanks.
Kudos to you. Kudos to you.
Appreciate that. It was tough.
Yeah, I bet it was. One other thing before we move on to infinite banking is why I think just curious as to your feedback. There's everyone knows the old adage or saying of like, don't chase shiny objects, stay focused, maintain laser focus, whatever it is, whatever industry or whatever, niche you decide to go down in the entrepreneurial world, whether it's real estate or owning a business, what have you. And so just curious as to how you managed, I guess you're running multiple clothing stores, kind of expanding that enterprise, but also, being in the financial advisory world, which I know is grueling, especially in the first couple of years, right? As you're trying to gain your footing, just how you manage any dilution of focus, and
Yeah.
kind of spinning those various plates.
It's a really good question, and I'm going to unpack it real quick in the sake of time. But there was a decision I had to make when I entered Wall Street. Because I was at that point, everything, my entire existence was that shop. I worked 10 in the morning till 9 at night most days, and I guess when you become an entrepreneur at a young age, you don't have that mental block that so many others do that work in corporate America of 9 to 5. You just do what is necessary, and back then it was just, hey, I worked 10 till 9, and that was literally normal. Like, I didn't think it was like, oh, wow, I'm working a lot. I loved every minute. But when I entered Wall Street, I no longer could do that. So I was forced to change from working in the business to working on the business. I had a
Hmm.
couple key employees that were friends of mine that I promoted them to managers, and I gave them roles that I felt they would be, excel at. And I thought, oh, at this point, you got to understand, my business was really suffering. So I didn't care. I just needed to go do what I had to do. So if the business did worse, or even if it failed, it was what it was. So I didn't care what happened. I mean, I did, but I didn't, because mom's
Hmm.
house was, no longer collateralizing the loan
Sure.
at this point. So I had to do it, but it gave me the ability to now pull out of the business. They ran it. I came in on special occasion. I came in on weekends. I came in during the holidays. But what I was started to do is I started working on like promotional things and marketing, and I started working on events and building a skate and snowboard team and all the things that I could never have done if I was working in the business, because
Hmm.
I would just be working with customers. Now I'm just working on, how do we get more customers? How do we market this? How do we build a brand? And everything changed. And that, I think, is the most valuable thing I learned. I learned it by force. And unfortunately, a lot of entrepreneurs have to learn it by force. But I, if I don't, if that didn't happen, I don't know what would have happened, because I would have just
Hmm.
continued to work in the business. And I think that's a huge mistake a lot of entrepreneurs make, is they work in their business for too long, and then they literally created a job for themselves that they can
Yeah.
never get out of. And I was fortunate enough by force to get out of that role.
Great lesson. Great lesson. It's again, during challenging times, sometimes we fail to step back or just acknowledge the fact that there's probably a really good lesson, multiple lessons during this challenge, that why I can't see it today because I'm stuck in the mess of it. Given in due time, ultimately, if you reflect back, you'll find that ultimately that challenging time just created a much tougher individual, and probably brought a lot of positive lessons to the equation. So
100%.
um let's talk about the mechanics. Infinite banking, I guess, you teach us, so I'm not going to try to drive the ship of like how we want to divulge this to the listeners here today, but infinite banking, I guess, what is it, who's it for, and just the basic mechanics of it, so we have a
Yeah,
firm understanding.
it's very misunderstood, and there's a lot of people, I think, that go out there and try teaching it, and they teach it very wrong, because it is so freaking simple. We all understand what infinite
Mhm.
banking is. We just don't understand it because we're on the other side of it. Infinite banking concepts is nothing more than a process. Everybody says, no, it's a product. It's that specially designed whole life. No, it is a process. Do not mistake that. You'll never, ever get rich because you change your money and put it into a whole life policy. I want to be very clear about that, because a lot of people are like, well, wait a second, I thought that was the whole thing. Absolutely not. It's a process. And all it is the process of taking back the banking functions in your life. And let me explain that, so that first we'll start with the concept of what we're trying to do. Every single person watching this, all of you go out there, you work for money, you make money, and you typically find a place to put that money, and then you find another place to put it, work or invest it, is what most people would call it. So in that also, you have bills and you have expenses and you have debts. So let's just start with debts. That's the easiest one for me to articulate. When you have credit card debts, every month you make a payment, but you very rarely ever articulate that interest rate that you're paying them, how much that really is. Let's call it 20% on most credit cards nowadays, because it's actually north of that. Every month you're giving that money away, which is eroding your wealth producing ability, because you're just paying somebody else. And let's add car payments, let's add mortgages, let's add every debt you have. Real estate investors, I want all real estate investors listening to this to understand there's good and bad debt. I'm simply talking about bad debt. In real estate, to scale, you're going to need leverage. You're going to use mortgages. And if you're bringing in enough cash flow to support your mortgage, please discount that for right now. I'm talking about the money going away that is not cash producing.
Mhm.
Fair enough?
Yep.
So here'd be the thought, okay? And I don't want to even include the product. I want to just talk about the process. Imagine this. Imagine if on a piece of paper you wrote down all the payments you make on the credit cards, the lines of credit, the car payments, and any other debt that you have outside of your real estate investments debt. Imagine how much money that is. Write it on a paper. How much is it? 2,000, 3,000, 10,000 a month? That's money that's gone every single year from your family, and it never comes back and never amounts to anything else. That money stopped working for you and it's now working for somebody else. But what if by changing one thing and adding one step, all that money that you're giving away could come back to you? Think of this as a real game of Monopoly. In Monopoly, you start the game at go and you try to cross go to get your 200, but then you pick up assets along the way that produce income. This is no different. So let's just start with picking up the assets that you're giving away, which is the debt payments you're making. We're going to build wealth through debts and expenses. So now, let's just say you saved up money. Again, let's just use a savings account because it's easier for me to explain the process in common terms. You start saving money in a savings, okay? You got that money sitting there. But let's just say you owe Visa $5,000 and every month you pay Visa $200 a month. Let's take $5,000 from your savings after you saved it up. Let's pay Visa off. But then let's not stop making payments of $200 a month at 20%. Let's keep making $200 payments, but change the name on the check from Visa to your name. And now every single month, $200, the money you used to give to Visa, is now going to come back over to the same savings account the money came from. All we did is we created a circle. Money started in this savings account, went over to pay off Visa. Now the money you were paying Visa comes back to your savings account. If you ran a calculation at 20%, because that's probably what you're giving away, and you figured out how long would it take for you to get the $5,000 back, you'd be blown away at how fast that would happen. You would regenerate all that $5,000 that you just gave to Visa. Not only that, now you'd have that money earning interest and dividends if you found a savings account that actually paid you a decent interest rate. But in that same process, let's say you kept doing that. As you paid Visa off, you took the money that you used to give to Visa and you used that plus the savings you were doing to pay off your car. And then you still made the car payment, but you made the car payment back to yourself. And then you paid off the line of credit and you made the line of credit payment back to yourself. How fast would you build wealth? The answer is, and I have all the math, incredibly fast, because all you would be doing is taking back money that you're giving away that you think is just normal. And all that money now it went from being a liability or a payment to now being an asset. Now I'm going to blow your mind. Now just imagine this. Instead of using the savings account, okay, what we did is we changed where that money went first. All the money I just mentioned, the savings and all the recaptured money from paying off all your debts, let's just say that money was changed. And we found a machine that would pay guaranteed interest, pay you dividends on a tax-free basis, and you'd be able to use that money anytime you wanted, but never interrupt the compounding growth that money earned. When I first heard this, like I explained in the Mike story, I did not believe any vehicle on earth could do that. And I would tell anyone that told me that there's nothing like that out there. I'm sorry. But there is, and there has been, and it's been around for hundreds of years, and the wealthiest families in history have known about it, from the Rothschilds to the Rockefellers, Morgan Stanleys, Ray Kroc, Walt Disney. I could keep going. They have all done exactly what I'm about to tell you. So don't think this is weird when I tell you this, because every wealthy family would say you're the weird one for not knowing this, because we've been using this for hundreds of years. If we changed where your savings went and we put it into, and preface these two words, specially designed. Okay. It's very important that you understand specially designed. Whole life insurance policy from a mutually owned company that paid dividends. Now, everyone listening heard was whole life insurance, and instantly they said, bad, bad, bad. Dave Ramsey, Susie Orman all said this is the worst place you can put your money. I might agree with Dave and Susie if we were talking about a regular whole life policy that your broke ass brother-in-law tried selling you. But what you missed is specially designed. Banks know all about this, and they're the number one purchasers of this. Look it up, BOLI, B-O-L-I. But the reason we use whole life from a mutually owned company is it is the only vehicle that can do what I'm going to explain and what I just did. So now we put our savings, okay, the money we were putting in a bank account, we change it and we put it into this specially designed whole life. But we're now going to do exactly what I just explained. The debts, the car, the line of credit. But now when we put the money in the whole life, we are immediately, when the money goes in there, we're going to take a loan from our bank. The whole life becomes our banking system. So we're going to take a loan from the whole life and we're going to pay off Visa. Remember, we're just doing the same thing. We pay $5,000 to Visa, but that 5,000 came from the whole life policy, and the insurance company gave you a loan for $5,000 to pay off Visa. Now, let me ask you a question. If you saved up $5,000 and you took $5,000 out, how much is left in the whole life?
Yeah, still
Most
5 grand. Yeah.
Well, you're right, but most
Yeah.
people listening are like, if I had five and I used five, there's zero left, right? Because they're thinking
Yeah.
like a savings account or a bank account. Wrong. There's still $5,000 earning
Mhm.
interest and dividends, which by most of the companies we use is right around 6% right now. And this is the part that you must understand. You didn't use your own $5,000. I said this earlier, but probably didn't pick it up, so I'm going to repeat it. The insurance company loaned you $5,000. But that loan that they gave you really never needs to be paid back, because what the insurance company did is the insurance company went into one of the guarantees in that specially designed whole life, which is your death benefit, the money they'll pay when you die, and they gave you $5,000 of your death benefit while you're living. They literally went to their general account and gave you $5,000, but there was no loan application. There was no collateral. They don't even ask any questions outside of, is this a divorce decree? Is this illegal? And where do you want the money? And then the money goes to your account immediately. When your check clears your whole life policy, you get to use this. There is no lag in the liquidity of the money with the specially designed aspect. So now we just paid Visa off, but now we still got $5,000 earning interest and dividends, which the bank account couldn't do. But remember, I said then what we're going to do is we're going to make $200 payments, which is the amount we gave to Visa, back to the place where it came. Well, where did the money come from? That specially designed whole life. So now we're making the 200 we were giving away, we're paying it back to the whole life. How much money do you have every $200 payment you make back to the whole life? You have $200 more. Okay, because you're putting it back in your banking system. But what you're also doing is you're paying down the loan to the insurance company. Now, remember, the insurance company gave you a loan of the death benefit. Every month now, the 200 you were giving away is replenishing the $200 of your death benefit that you got as a loan, which the insurance company charges you interest on that loan, but it's simple interest paid one time per year. So the $200 that's coming back that was 20, yes, of that 20% you were giving away to Visa, the insurance company is going to keep roughly about 5.2% of that right now. But how many times did you make money on every dollar you put into that whole life? Let's do the math. The whole life insurance policy paid you interest and dividends tax-free at a rate of right around 6%, of which they charged you 5% simple interest. So, like a bank, when the bank gets your deposit, they pay you interest on it, but then they lend your money out at a higher interest rate. They make a spread. Is 6 minus 5, is that a spread for
Mhm.
you? It is. You make money. But every year that number goes up because every year you're compounding on a higher amount. So that's making money once. But then hold on, wait a second. We took the loan from the policy and we paid off Visa. And Visa was charging us 20%, but we're now paying that same payment back to our policy. So that's 20%. So we could do the same thing. We could say 20 minus 5 is 15. So now we're making 15 there. But you see, I just told you you're making money twice on the same dollar, but I netted it out for the amount you were paying the insurance company. But remember, you're only going to take the insurance company's interest from one or the other. Is it going to come from the interest the insurance company is paying you, or is it going to come from the money that you're making by paying yourself back for the Visa, the car loan, everything else? Folks, that's the infinite banking concept. You become the bank because now you can operate like a bank, because you can make a spread on every single dollar. And you can make that money work for you the same way a bank does, by lending it out or by using it to take back control of the money you're giving away. You see, it doesn't stop at debts. It continues on in real estate. It continues on in private lending. There is no end to it, which is why it's called the infinite banking concepts.
No, I love that. That's a lot to unpack, but no, that great job explaining it in a very easy to understand manner, Chris. So I guess a couple questions that immediately come to mind as far as getting started. What's the initial contribution amount? Is there a minimum amount? Is there a maximum amount? To get this rolling?
Yeah, so it's simple. You can start at any amount you want. The minimum would be take your age, add a zero behind it. That's your minimum monthly. And it doesn't have to be monthly, but I'm 47, so my minimum would be 470 a month. That's the minimum. Maximum is only determined by the insurance company's human life value, but it's a lot. Well, let's just leave it at that.
Is that max? That's an annual contribution amount, the maximum amount?
Correct. Yep. It's based on your income, your assets, and your future earning potential as just a person.
Like, give me an
They're going
example.
to
I mean,
tell
is
you.
there just like a baseline we could maybe use? I know that everyone's situation is different, but is there
Oh
a
goodness. So let's just say somebody had an income of 100,000, they had assets of about $1 million. They could probably get right around $8 to $10 million worth of death benefit, about 10 times, give or take. And this isn't exact. I'm just giving you a ballpark. So, if you had $1 million net worth, you could probably get $10 million in coverage, which would give you the ability to put dollars and cents into, you'd probably do about mil five into the policy every year.
Okay.
And
Got
that's
it.
very specific. There's a lot of variables in that:
No,
age, health.
understood.
Yeah.
Understood. And then what percentage of that death benefit can you take a loan against? Is it 100% or is there a
You'll never
formula
be able
there?
to take 100% because you can only take out what you have in cash value. So let's say you were putting a 10,000 bucks away per year into the policy, which gave you a million. Let's just say it gave you $1 million death benefit. I don't think it would be that high, but
Hmm.
now you got $1 million of death benefit and you've got $10,000 in cash value. Just keeping numbers simple. You can take up to the amount of cash value you have. So 10 grand of the
Got it.
$1 million death benefit, because the insurance company is going to use your 10 grand that doesn't leave your account as collateral. That's
Got
how
it.
they protect themselves.
Understood. Understood. And then once we have this set up, is there a period of time that we have to wait before we can actually take a loan out against the policy?
No, it's immediate when your check clears. You just won't have access to 100% of your deposits. And usually, depending on it, can be year 2 to year 5 that you'd have 100%. So if you put 10 grand in a policy we designed for you, you'd have roughly about 88 to 8,500 you could take out immediately in the first 30 days. But then the next year, if you put 10 grand, you're going to be able to take more like 9 to 9,500 out. And the third year, put 10 grand in, you're going to take more than 10 grand out. We call that the efficiency point. So every policy we design, there's going to be that lag in the first couple of years because there is a cost of insurance that comes along with that.
Hmm.
So those first couple of years, you don't have access to 100%. But think of it this way: if for 3 years I don't have access to 100%, but after the third year, every single year, every dollar I put in, I take out more than I put in, and it keeps compounding up. Would anyone give up for 3 years? Would you give an earning up for 3 years so that for the rest of your life, every year you're guaranteed to have more money than you did the next year?
Yeah, absolutely.
It's a simple thing.
No brainer. No brainer. So obviously this takes some discipline.
It definitely
Not all
does.
of us are. Not all of us are. And so you'll speak to the individual that ultimately they're the right fit for this. I mean, this sounds very interesting to them, but just managing the process and
Managing
making
the
it as simple as possible. How do you do that?
Well, I mean, what we did as a company is we literally built an implementation team. So we have a team of people that implement this for every one of our clients, and we have 16,000 clients in this country.
Hmm.
And our team manages and helps them implement the infinite banking concept. And then we do quarterly calls with all of our clients to make sure that they're on track. What we've also done is built software that we give away to our clients for free. We don't charge for any of this. I mean, the only cost that any client's going to have is the cost of insurance in the policy. I mean, we're
Hmm.
paid by the insurance company, even though they pay us 60 to 90% less commission than a regular insurance policy would because of the design. But that's how we're compensated. And the software we built allows our clients to manage and implement the process without a whole lot of work because it is. You're right. You got to be diligent. You got to stick to the process, and you got to continue to be the bank and treat your money the same as you would if you were using the bank's money. And that's where people fail at this.
Yeah. Who might this not be good for?
Perfect question. So it's not for the person that isn't saving money. It's not for the person that is
Mhm.
living paycheck to paycheck. And it's definitely not for the person that wants to get rich quick. This is not a fast process. You are not going to get wealthy fast, but you know what? You will stay wealthy long. Okay. Because the way we build wealth, although it takes time, it is a surefire wealth building strategy. And once you build it, and stick to the process, you will never give the money back.
Mm. Yeah, no, very, very interesting. What else, Chris? What else do we need to know? Again, just want to be conscious of the time here, but just
Yep.
important. You covered a lot of ground, ton of ground. Again, surely piqued a lot of interest of those that are tuning in, and we'll be sure to plug your website and any other resources you're offering before we wrap it up here. But just any other key elements
Yeah, I
that
think
that's
there's
critical to speak to here.
some really key things here that you must understand. Remember, I said it earlier, I'll say it again. It's the process that you need to learn. It's the banking process called the infinite banking concepts that you must
Mhm.
learn. Everybody's now focused on this whole life product, the specially designed whole life. That is an important component because that allows you to earn uninterrupted compounding interest on a tax-free basis and also get the legacy piece to protect your family. However, that's not the most important part. So I've got lots of videos out there that teach this, that show you that process in many different ways. But here's just a little thing just to kind of get you all interested, like cars. We all must buy cars, and we're always going to have, cars throughout our lives. Imagine if you found a way to get all the money back for every single car you ever buy, drive, and own. Would you learn how to do that? And would you do that for every car you bought? Well, this is the way to do that.
Yeah.
It's absolutely certain you're going to get every dollar back for every single car you buy, drive, and own. But that's the process that allows you to do that, not just the product. So those are the most important things. Will Rogers said a profound quote that I think is the most applicable to what we just went over. And he said, the biggest problem in America is not what people don't know. He said, the biggest problem in America is what people think that they know that just ain't so.
I love it. I love it. Well, Chris, for those that want to learn more, where's the best place to track down you and more information? I know you got a ton of different resources on the website, but where's the best place to point them?
Well, the website is Be Your Own Bank or BeYourOwnBanker.com, and a 90-minute video will pop up, or you could go to chrisnoggle.com. A 90-minute video will pop up. Watch that video. It is the most in-depth training on how this works. But then once you watch that 90-minute video, if you want to book a call, you can. The best resource is my YouTube channel, and I'm on every social media channel, and my handle is at the Chris Naugle, Naugle. I have over 1,000 videos on YouTube showing this concept, explaining it, case studies, but it all comes down to the mathematics. Everything that I do, everything I teach, and everything I help clients with is 100% backed by mathematics, because that's the biggest thing. I can prove every scenario with math, and that's what my YouTube channel does.
Fantastic. Well, Chris, it's been a pleasure, my friend. I appreciate you coming on here today. And I will tell you that I think we talked about this when I was on your show, is that I've got background envy. So kudos to you with the studio as well. Your videos are well done, and lots of great information. I've actually watched a number of them in between the last time that we connected. So just great job on what you got going on there. And with that, guys, I'll be sure to put all those links in the show notes. And Chris, my friend, until next time, you take care. Okay.
I really appreciate it. Thank you.
Guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.